If you look around at American life right now, there is this bizarre contradiction sitting squarely at the center of it.
Right.
And it's one of those things that once you notice it, you cannot stop seeing it. It honestly makes you feel like you're losing your mind.
Oh, I know exactly what you mean.
Think about your own life or, the people in your immediate circle. You might have a genuinely good job. You're earning a salary that maybe 5 or 10 years ago you thought would make you financially invincible.
Yeah, the dream salary.
Right. You own a reliable car. You live in a decent home. Your kids are in a good school. To your neighbors and your friends on social media, even your parents at the Thanksgiving table, you look incredibly successful.
On paper, you've won.
Exactly. On paper, you check every single box on the American Dream checklist.
Yeah.
And yet, despite all of that, you still feel completely, totally broke.
It is such a pervasive feeling across the country right now. And before we go any further, I think it's crucial to clarify what we mean by the term broke in this specific context.
Right, because we aren't talking about poverty here.
No, not at all. We are not talking about deep poverty or unemployment, food insecurity, the kind of systemic desperation that requires a completely different economic conversation.
Yeah, that's a whole other show.
Exactly. We are talking about the sensation of feeling utterly trapped by your own success.
Trapped is the exact word. I mean, it's this creeping realization that you are earning more money than you ever have in your entire adult life, but mysteriously, there's just never a single dollar left at the end of the month.
It just vanishes.
It really does. You work hard, you get that promotion, your gross salary bumps up, and before the ink is even dry on the new contract, the universe just absorbs it.
The property taxes jump.
The property taxes jump.
Yeah.
And the auto insurance premium spikes, healthcare premiums go up, childcare costs increase, and the grocery bill just silently inflates. It all evaporates.
It's the invisible drain.
And the real psychological toll, I mean, the thing that keeps you staring at the ceiling at 2 in the morning, is the fragile reality of it all. Like if one unexpected thing happens, a transmission blowing out on the highway or a sudden medical emergency, this entire fortress of financial security you think you've built could just collapse.
Well, that underlying anxiety is mathematically validated by the microeconomic data we are seeing right now.
It's not just in our heads.
Not at all. What you are describing and what millions of listeners are experiencing is not a sudden collective failure of personal budgeting.
Right. We didn't just forget how to do math.
No, we didn't wake up a few years ago and forget how to balance the checkbook.
Yeah.
What we are witnessing is a fundamental structural mutation in the actual mechanics of what it costs to exist in the middle class.
The baseline has shifted.
Exactly. The financial anatomy of a normal life has changed entirely.
Which brings us to the mission for this deep dive. Today, we are taking you through a brand new, highly detailed investigative documentary from Smart Money USA.
It's a fantastic piece of work.
It really is. We have their full script, their proprietary data sets, their primary sources, and we are going to use all of it to dissect the true financial anatomy of the modern American middle class.
To figure out why it feels so broken.
Right. We need to figure out why earning a solid income while feeling financially suffocated has become the new baseline reality for so many of you listening.
And the documentary takes a really forensic approach, which I appreciate. We will be analyzing historical data to understand how the goalposts for financial security were moved over the last 50 years.
Because they definitely moved.
Oh, massively. We will examine the Bureau of Labor Statistics data to see the reality of household spending, where the money actually goes versus where we think it goes.
That part is eye-opening.
It is.
Yeah.
And perhaps most importantly, we will dissect the behavioral and psychological mechanisms. The things that explain why navigating the middle class today feels exponentially more treacherous than it did for previous generations.
So I was looking at the demographic data in the source packet before we started, and the very first thing the documentary does is attack the label middle class itself.
It's a highly problematic label.
It really is. Frankly, when you look at the numbers, the term seems completely divorced from reality. I want to look specifically at the 2022 data from the Pew Research Center that they cited.
Yeah, let's break that down. The Pew Research Center relies on a very specific mathematical formula to define middle-income households.
Which is what, exactly?
They classify it as anyone earning between two-thirds and twice the national median household income, adjusted for household size.
Okay, so just a straight math equation.
Right. So when you run those numbers for 2022, specifically for a three-person household, the middle-class income range starts at $56,600
Okay.
and goes all the way up to $169,800.
I have to pause on that because the spread there is astronomical.
It's massive.
If the gap between the bottom of the middle class and the top of the middle class is over $110,000, the label itself has just lost all utility.
It becomes functionally meaningless.
Right, because putting a family making $60,000 in a small town in Ohio into the exact same economic bucket as a family making $160,000 in San Francisco is absurd.
They share almost no overlapping economic realities.
None. Those are two fundamentally different universes of existence.
And that is the documentary's primary critique of how we measure prosperity. Income as a gross metric on a W-2 form is becoming a fundamentally flawed indicator of social class or financial stability.
Because it doesn't account for life.
Exactly.
Right.
A single professional earning $100,000 in a low-tax state has a wildly different life trajectory than a family of four earning that exact same gross amount in a high-tax, high-cost coastal city.
Yeah, geography drastically alters the math.
Geography alters it. Family size alters it. State and local tax burdens completely warp the math.
So if looking at the top-line revenue of a household is a broken metric, how does the source material suggest we actually measure who is in the middle class?
Well, researchers argue for a shift away from gross income toward a metric defined as economic security.
Economic security.
Right. It operates more like a checklist of financial capabilities rather than just a tax bracket.
Okay, what's on the checklist?
The criteria involve asking some pretty tough questions. Can the household pay all structural bills without resorting to high-interest debt?
That's a big one right there.
Yeah. Can they absorb a moderate emergency? Can they realistically purchase a home in their local market?
Good luck in California.
Exactly. Can they afford the out-of-pocket costs of raising children? Can they consistently fund a retirement vehicle?
And what's the last one?
The most crucial qualitative metric, really, can they accomplish all of this without experiencing chronic, low-grade panic about their cash flow?
Wow. I really appreciate that framework because it shifts the focus from what you make to how you actually live.
It's much more accurate to the human experience.
But it is also incredibly sobering because when you apply that specific checklist to the people you know, you realize how many six-figure earners instantly fail the test.
A shocking amount of them fail.
But I am trying to square this current reality with recent history. Because if we look back at the post-World War II generation, or, even just our grandparents.
The golden era of the middle class,
Yeah.
quote unquote.
Right. They seem to achieve that exact checklist of economic security with remarkable ease. And they often did it on a single income.
Yeah. To reconcile that gap between our grandparents' reality and ours, the documentary pulls in some long-run historical data.
What does it show?
Well, the post-WWII economic blueprint was highly standardized and largely accessible. A household could rely on one, perhaps two incomes.
Usually just one for a long time.
Right. They purchased a starter home, maintained a vehicle, raised a family, benefited from defined benefit pension plans, and eventually the mortgage was amortized to zero.
Which is the dream, right?
Yeah. Absolutely. The household ended up owning a major asset, free and clear, which provided ultimate security in retirement.
And it functioned beautifully for a massive swath of the country. So the obvious assumption most people make today is that wages must have just stagnated.
That's the common belief.
We always hear that inflation went up and wages stayed flat. But the data in the Smart Money USA documentary actually contradicts that narrative, doesn't it?
It does. The narrative of complete wage stagnation is a slight mischaracterization of the broader macroeconomic picture.
So wages did go up.
Mathematically, yes. The middle class did grow wealthier in real terms. The Pew long-run analysis compares inflation-adjusted data from 1970 to 2022, scaled for a three-person household.
Okay, give me the number.
In 1970, the median income of those middle-class households was approximately $66,400. By 2022, that median income had risen to $106,100.
Oh, wow. So we're looking at roughly a 60% increase in real inflation-adjusted purchasing power.
Yes, a 60% increase is substantial.
It really is.
However, the mechanism that explains our current anxiety lies in how the broader economic gains were distributed across the entire system.
Okay, how were they distributed?
Well, during that exact same 52-year window, upper-income households saw their median income rise by approximately 78%.
78%.
Right, moving from $144,100 to $256,900.
Okay, let me try to contextualize that because raw percentages can be hard to visualize for you listening at home.
Yeah, an analogy helps here.
It's essentially like participating in a marathon where your personal running speed has improved by 60% over the years.
You're running a great race.
You feel faster, you're pushing harder, and objectively your times are way better. But while you were training, the organizers made the marathon course twice as long.
Right.
And the runners in the elite wave ahead of you were quietly handed motorcycles.
That is a perfect way to look at it.
You are running faster than you ever have in your life. But the gap between you and the leaders is widening at an accelerating rate.
That analogy perfectly captures the systemic friction the documentary highlights. The crucial distinction to draw here is the difference between earning more capital and possessing the ability to afford more life.
Afford more life. I like that phrasing.
Yes, the absolute dollar amount on the middle-class paycheck is higher today, but the underlying cost structure of the American economy fundamentally mutated.
The track got longer.
The racetrack didn't just get longer. The terrain you have to run on changed from asphalt to quicksand.
Which leads us to the most infuriating aspect of modern financial discourse.
Oh, I know where you're going with this.
Because anytime you try to express this feeling of structural quicksand, a cottage industry of social media financial gurus immediately pops up to blame your struggles on minor discretionary choices.
The infamous latte effect.
Yes, we've all heard the lecture. You are struggling because you buy $6 lattes, you indulge in avocado toast, you have too many streaming subscriptions.
They frame systemic macroeconomic shifts as a failure of personal discipline.
It's insulting.
It is, and the documentary attacks that specific narrative using hard data from the Bureau of Labor Statistics.
Good. What does the BLS data actually say?
The BLS Consumer Expenditure Survey tracks the precise allocation of American household dollars, and the 2024 data thoroughly dismantles the latte myth.
Let's hear it.
In 2024, average annual consumer expenditures hit $78,535.
Almost $80,000 a year just to keep the lights on and the engine running.
Correct.
How does the BLS break down where that massive sum is actually going?
The vast majority of it is swallowed by just 5 structural categories.
Just 5.
Just 5. Housing is the Leviathan, consuming 33.4% of all spending.
Okay, a third of it right there.
Transportation accounts for another 17%.
So we're at 50% just for a roof and a car.
Exactly. Then, food represents 12.9%. Healthcare takes 7.9%. And personal insurance, along with pension contributions, absorbs 12.5%.
Let me just doing the rough math in my head on those percentages. 33 plus 17 is 50. Add the 12, 7, and 12, we are looking at nearly 84%.
84%.
So 84% of an $80,000 annual budget is completely captive to just 5 categories.
And none of those categories are lattes.
Right. We are not losing a financial battle because of a monthly Netflix subscription. We are fighting a war against massive, unmovable structural monoliths.
The underlying economic mechanism driving this stress is the difference between discretionary and mandatory expenses.
Break that down for us.
A streaming service or a restaurant meal is highly discretionary. You retain total agency over those dollars.
I can just cancel Netflix on my phone right now.
Exactly. If you experience a cash crunch, you can instantly alter that behavior. But mandatory expenses offer no such elasticity.
You can't cancel your house.
No, you cannot inform your local government that you are pausing your property taxes this quarter. You cannot opt out of commuting to your job. You cannot defer an emergency appendectomy.
And if you call your auto insurance provider and tell them you need to skip a few premium payments because inflation is hitting your grocery budget, they just cancel your policy.
Immediately.
And in most states, driving without that policy is illegal. So you are legally mandated to pay a cost you cannot control.
That lack of budgetary elasticity is the genesis of the psychological trap.
It feels suffocating.
Because it is. When the cost of a discretionary item rises, it is an annoyance, but you maintain the power to simply abstain. When the cost of mandatory infrastructure rises, when rent goes up or medical premiums compound, your agency is forcibly stripped from you.
You just have to eat the cost.
You are compelled to absorb the increase, which mathematically requires you to cannibalize the remaining 16% of your discretionary budget to bridge the gap.
Wow. Let's pull the lens in on the biggest piece of that 84% pie, because it is the primary engine of middle-class anxiety.
Housing.
Housing. It consumes 33.4% of the budget. Why has this specific sector become such a hostile environment for average earners?
The housing crisis requires us to examine a massive behavioral and financial shift in how Americans view real estate.
How so?
Historically, purchasing a home was primarily an act of securing shelter. It was treated economically as consumption.
You bought a house to live in it.
Right.
Right.
But beginning in the late 20th century, structural changes in the economy transformed the single-family home from mere shelter into a hyper-financialized investment vehicle.
It became the retirement plan.
It became the default mechanism for the middle class to build and store wealth. And the moment an essential human need is widely adopted as a primary investment asset, its price behavior completely detaches from local wages.
Because it's an asset now, not just a commodity. The documentary pulled some historical Census Bureau data to illustrate this detachment, and the slope of the graph is staggering.
It really is. Even when strictly adjusting for inflation to ensure an apples-to-apples comparison, the census data shows the median value of single-family homes increased nearly fourfold between 1940 and 2000.
Fourfold.
It quadrupled in real terms over 60 years. And as we know, the trajectory has only steepened aggressively in the 2 decades since.
Which creates a brutal paradox regarding timing and generational wealth.
It's all about when you were born.
Right. If you happen to be born early enough to buy a house 30 years ago, this systemic price surge is the foundation of your net worth. You are sitting on hundreds of thousands of dollars in unearned equity simply because you existed at the right time.
You won the geographic and temporal lottery.
But if you're a young family trying to enter the market today, that exact same price surge acts as an impenetrable wall.
A wall you can't climb.
You can execute the entire playbook perfectly. Excellent grades, lucrative degree, responsible savings rate, zero mistakes, and still find yourself locked out of the market entirely by the sheer bad luck of your birth year.
The systemic paradox creates a bifurcated economy based on asset ownership.
The haves and the have-nots.
Precisely. The older generation holds an appreciating asset, and their primary housing cost, the mortgage principal and interest, is largely fixed, often secured at historically low interest rates.
Those sub 3% mortgages.
The golden handcuffs. Meanwhile, the newer generation is relegated to the rental market, where costs compound annually as a total loss.
While they simultaneously attempt to save for a down payment on an asset that is appreciating faster than their wages can compound.
It's a race they mathematically cannot win.
And it isn't just the sticker price of the home that is doing the damage. The documentary heavily emphasizes the carrying costs. Because once you buy the house, you have to feed it.
The carrying cost is often the fatal blind spot in middle-class budgets.
How bad is it?
When home valuations surge, every peripheral expense tied to that valuation surges in tandem. The initial mortgage principal is massive. The interest payments require vastly more capital.
Especially at today's rates.
Property taxes, which municipalities assess based on the inflated value of the home, adjust upward perpetually.
They never go down.
Never. Homeowners' insurance premiums are experiencing unprecedented spikes nationwide, driven by inflated rebuilding costs and shifting climate risks.
Even just keeping the lights on costs more.
Basic maintenance and utility costs are scaling at rates well above baseline inflation.
So you pour an exorbitant amount of capital into acquiring the house, and then you bleed cash every month just to maintain it.
That's the reality.
And then when you leave that expensive house to commute to the job that pays for the house, you step directly into the second massive financial trap, the car.
Transportation represents 17% of the average household budget, making it the second largest monolith.
I want listeners to really process that number. Nearly 1/5 of every dollar you earn is completely vaporized just to move your physical body from your house to your workplace and back.
It's incredible when you frame it that way.
Why are we so captive to this?
The root of this dependency is zoning and urban design. Outside of a select few dense legacy urban centers with legacy public transit systems, the automobile is not a luxury item in America.
It's a requirement.
It is mandatory infrastructure. You cannot reliably participate in the modern economy, transport your children to educational facilities, or access health care without private transportation.
And much like housing, people tend to anchor their understanding of transportation costs solely on the monthly loan payment.
Which is just the tip of the iceberg.
Right. But the ecosystem of expenses surrounding the vehicle is what actually destroys the budget.
We categorize these as hidden, recurring, carrying costs.
What's included in that?
Well, the financing itself has become vastly more expensive as interest rates have normalized. But beyond the loan, you have mandatory comprehensive insurance, which has seen dramatic double-digit percentage spikes over the last few years.
It feels like insurance doubles every year now.
You have the inherent volatility of fuel prices. You have routine maintenance, inevitable repairs, state registration fees, and municipal property taxes on the vehicle.
Death by 1,000 cuts.
But the most insidious financial drain is depreciation.
Right. Because unlike a house, which at least has the potential to appreciate and act as a store of value, a car is a depreciating liability.
It is a falling knife.
You are legally forced to pour 17% of your hard-earned income into a piece of machinery that is actively decaying and losing financial value every single time you turn the key.
And returning to the concept of mandatory versus discretionary spending, when the cost of parts and labor drives auto insurance premiums up by 20% in a single year, the household cannot opt out.
They just have to find the money.
They must absorb the cost to remain legally compliant and economically active.
Okay, so we have established that housing and transportation immediately devour half of the average income before a family even buys a single box of cereal.
Half your labor gone.
And this transitions perfectly into the documentary's analysis of inflation, which acts as an invisible tax on the remaining funds.
The inflation segment is crucial.
I found this section particularly illuminating because there is a severe disconnect between how inflation is reported by the government and how it is actually experienced by the consumer at the checkout counter.
The public misunderstanding of inflation metrics is profound.
How does the documentary explain it?
To illustrate this, the source utilizes the Bureau of Labor Statistics data from June 2026. The BLS reported that the Consumer Price Index, or CPI, was up 3.5% year over year.
Okay, 3.5.
Within that, shelter costs were up 3.3%, and food at home was up 3.0%.
Right, and when those numbers hit the evening news, the anchor usually presents it as a victory. They say, "Great news, inflation is cooling down. It has dropped to 3.5%.
Which technically it has.
But anyone listening who recently went to the grocery store feels like they are being gaslit. Because they look at their receipt and think, cooling down, I just paid $9 for a block of cheese. Why is my life still so incredibly expensive if inflation is supposedly fixed?
The confusion stems from a fundamental misunderstanding of the mathematics of disinflation versus deflation.
Clarify that for us.
The documentary clarifies this crucial mechanism. Slower inflation does not mean prices revert to their previous levels.
They don't go backward.
Never. It simply means prices are continuing to rise, but at a slightly slower velocity, launching from a new, painfully high baseline.
So 3% on top of the already inflated price.
Exactly. When the inflation rate falls from a crisis peak of 8% down to 3%, we do not experience deflation.
The Smart Money USA source used a fantastic, grounded analogy regarding a standard weekly grocery run to explain how this math actually traps the consumer.
Yes, the grocery basket example. Consider a household whose typical weekly grocery basket cost $150 in a pre-inflationary environment.
Sounds nice.
Right. A macroeconomic shock occurs, driving sustained, high inflation, and over the course of 2 years, that exact same basket of goods surges to $180.
A $30 hike.
Eventually, central banks intervene, the rate of inflation slows, and the government declares the crisis resolved because the annual inflation rate has dropped back to a quote-unquote normal 3%.
But the consumer is still trapped at the new baseline.
Precisely. Your weekly bill does not magically drop back to $150. Because inflation is still a positive number, your bill simply compounds from the new, elevated baseline of $180 up to $185.
It's just rising slower.
Right, rather than rocketing to $200. The massive, permanent loss of purchasing power incurred during the initial shock has been irrevocably baked into the financial architecture of your daily life.
The damage is permanent, and wages rarely adjust fast enough to compensate for that new baseline.
They almost never catch up in real time.
Which brings us to a statistic from the Federal Reserve that I think is the single most terrifying data point in this entire deep dive.
The $400 cliff.
The $400 cliff. The documentary refers to it using data from the Federal Reserve's annual survey of household economics and decision-making.
It is a benchmark study designed to gauge the actual financial resilience of the American public.
What exactly did they ask?
The survey asks respondents a very straightforward, hypothetical question. Could your household comfortably cover a $400 emergency expense using cash, savings, or a credit card paid off at the end of the month?
Just $400.
Just $400.
According to the 2024 data they cited, only 63% of adults stated they could cover it using cash equivalents.
It's a staggering failure rate.
That means nearly 4 out of every 10 adults in the United States cannot easily source $400 for a sudden emergency.
4 out of 10.
Now, you have to help me reconcile this math. We just spent the first half of this deep dive establishing that the middle class encompasses millions of households pulling in well over 6 figures.
Correct.
How is it mathematically possible to earn $120,000 a year and panic over a $400 repair bill for a broken washing machine?
The contradiction only resolves when you understand the strict economic divergence between two concepts that society constantly conflates.
Which are?
Income and liquidity.
Income and liquidity.
Right. Income measures the velocity of capital entering the household. Liquidity, which is a much more accurate proxy for wealth, measures what capital actually remains accessible after obligations are met.
It is the difference between measuring a river and measuring a reservoir.
Oh, that's a brilliant way to put it.
A household can have a massive, raging river of cash flowing in every 2 weeks. But if there are massive structural holes in the dam, the inflated mortgage, the 2 car payments, the childcare tuition, the grocery baseline, the water flows straight out the other side.
It never pools.
Right. The reservoir of actual savings remains bone dry.
That is the exact dynamic. High earners are frequently living highly fragile, high cash flow, but low liquidity lifestyles.
It's terrifying.
Because those mandatory compounding expenses we detailed earlier consume the entirety of the gross income before the capital ever truly settles into the household's control.
The money is spoken for before it even hits the checking account.
If your net monthly take-home pay is $10,000, but your structurally locked-in monthly obligations total $9,900, you may present as affluent to your peers, but functionally, your balance sheet is one flat tire away from a systemic crisis.
So let's follow the logic. If 4 out of 10 people lack the liquid cash, what actually happens when that transmission blows on the highway or their kid breaks an arm at soccer practice?
Well, the bill still has to be paid.
Exactly.
Yeah.
So where does the $400 originate?
It originates from the consumer debt machine.
The credit cards.
Yes. When a household's liquid capital is insufficient to bridge the gap between their income and the reality of their expenses, debt is utilized as a synthetic bridge.
A synthetic bridge.
And the scale of the synthetic bridging across the American economy is staggering.
Give us the numbers from the source.
The Federal Reserve Bank of New York reported that in the first quarter of 2026, total U.S. household debt had escalated to $18.8 trillion.
$18.8 trillion.
Trillion with a T.
The human brain cannot even accurately conceptualize a number that large.
It is a massive sum, and to properly analyze it, we really need to segment the data. Of that $18.8 trillion, mortgage balances naturally account for the lion's share, sitting at approximately $13.9 trillion.
I want to make sure we parse this correctly for the listener, because not all debt functions the same way in a household's financial ecosystem, right?
Absolutely not.
Carrying a mortgage balance is technically debt, but maxing out a high-interest credit card to buy groceries is a completely different financial behavior.
We must apply a strict analytical framework here and differentiate between productive debt and destructive consumer debt.
Let's start with productive debt.
Productive debt, often referred to colloquially as good debt, is capital borrowed strategically to acquire an asset that will appreciate in value or increase your future earning capacity.
Like the mortgage.
Right. A fixed-rate mortgage on a primary residence is generally considered productive, assuming the monthly carrying costs are sustainable, because it finances an asset that historically appreciates and provides necessary shelter.
What else falls into that category?
Similarly, a student loan that directly facilitates entry into a highly lucrative medical or engineering field is a productive use of leverage.
You are essentially renting the bank's money to build a larger financial engine for yourself in the long run.
Precisely. However, unsecured consumer debt functions completely differently.
This is the revolving credit cards, right?
Revolving credit card balances, high-interest personal loans used to cover operating expenses, or predatory auto loans financing rapidly depreciating luxury vehicles. That functions as destructive debt.
And the documentary utilizes a particularly chilling definition for this type of leverage.
It does. It defines consumer debt as future income being spent today.
Future income being spent today. I want listeners to really visualize that.
It's a dark concept.
It is. Consumer debt acts like a financial time machine. When you swipe that card for something you don't have the cash for, you are literally reaching months or years into the future, seizing money out of your future self's paycheck and dragging it back to the present to consume it today.
You're robbing your future self.
Exactly. But the horrifying reality is that when your future self finally arrives at that date, they still have to pay the rent, they still have to buy groceries, but their paycheck has already been spent by you in the past.
The time machine analogy is highly accurate, but you must also factor in the cost of time travel,
The interest.
which is compounding interest.
Because you are borrowing at rates that often exceed 20%, you are actually extracting significantly more capital from your future self than you are consuming in the present.
The bank takes a massive cut.
Once a household commits enough of its future baseline income to servicing the interest on yesterday's consumption, they lose all operational flexibility.
Treadmill speeds up.
They lose the capacity to absorb shocks, save for emergencies, or invest in appreciating assets. They are placed on an accelerating treadmill of debt service.
And that is the exact mechanism by which high-income households become utterly hopelessly trapped without ever technically falling below the poverty line.
It's a gilded cage. We have spent the last 40 minutes dissecting the cold, hard math of this trap. We've covered the hyper-financialization of housing, the structural dependency on automobiles, the baked-in nature of baseline inflation, and the gravity of compounding consumer debt.
The math is grim.
But the documentary shifts gears in its later sections to explore something I found equally fascinating, which is the psychological warfare inherent in being middle class today.
Oh, the behavioral economics section.
Yes, because part of the reason we're so willing to use that time machine to spend future income is the immense unspoken social pressure to project a specific image of success in the present.
The documentary delves deep into this phenomenon, specifically focusing on the concept of relative consumption.
Relative consumption, what is that?
Economists and sociologists have known for decades that human beings do not evaluate their own wealth or life satisfaction in a vacuum.
We don't just look at a spreadsheet and feel happy.
No, we do not look at our bank accounts objectively. Instead, we continuously evaluate our status relative to our peers, our physical neighbors, and, most aggressively in the modern era, the highly curated, algorithmically amplified lives we consume on social media.
It is the old concept of keeping up with the Joneses,
Yeah.
but it has been weaponized by technology.
The scale and velocity of the comparison have changed entirely. Historically, your reference group was limited to the people on your physical street or in your immediate office.
You just saw the guy next door.
Today, your neighbor might buy a new SUV. A colleague might take their family on a 2-week European vacation. And then you open an application on your phone, and a proprietary algorithm serves you thousands of hyper-targeted images.
Influencers dining at Michelin-starred restaurants.
Wearing luxury timepieces and renovating bespoke kitchens.
Is exhausting.
Even if your life is objectively comfortable and all your foundational needs are securely met, your internal reference point for what constitutes a normal middle-class life is artificially and aggressively moved upward.
A perfectly adequate, secure life suddenly feels acutely inadequate.
And this psychological vulnerability is exactly where the credit card industry does its most lethal work.
Because easy access to revolving credit fundamentally alters the internal dialogue we have when making a purchasing decision, doesn't it?
It absolutely does. It takes the core responsible question of, do I possess the total capital required to afford this item right now? And dangerously mutates it.
Mutates it into what?
Into, can I shuffle enough money around to make this month's minimum cash flow requirement?
Just focus on the monthly payment.
That cognitive shift is catastrophic for long-term wealth accumulation. When a consumer operates strictly on a cash basis, the boundary is physical and absolute.
If the money isn't there, you can't buy it.
If a household does not have the $6,000 required in liquid savings to book the European vacation, the transaction simply does not occur. The lack of capital enforces discipline.
But credit cards remove that friction.
Revolving credit abstracts the immediate pain of the purchase. It fractures a massive, unaffordable lump sum into a seemingly manageable, low-friction monthly minimum payment.
Which tricks your brain.
It incentivizes the consumer to prioritize immediate cash flow management over actual underlying affordability.
Which result in a society completely populated by people who look incredibly affluent in the grocery store aisle, but who are secretly drowning in cortisol and stress the moment they look at their banking app.
It's all a facade.
They are merely leasing the aesthetics of a middle-class lifestyle, rather than actually owning the underlying financial security.
Psychologically, prioritizing that monthly cash flow feels deeply soothing in the moment. It feels like a clever solution to the tension between what you earn and what society tells you should have.
It maintains the illusion of status.
Until, inevitably, a macroeconomic shock occurs, the compounding interest accelerates beyond the capacity of the income stream, and the future income they heavily mortgaged finally comes due.
The bill always comes due. I want to pivot slightly and play devil's advocate here.
Let's do it.
Because whenever this structural critique of the middle-class struggle is presented, there's a very common counter-argument from certain economists and commentators, and the documentary addresses this head-on.
The historical perspective argument. Let's unpack it.
The counter-argument essentially says, look around at the reality of modern American life. We are vastly, objectively wealthier as a society than we were 50 years ago.
Sure.
The technological advancements available to the average consumer are mind-blowing. We have massive, ultra-high-definition flat-screen televisions that cost a fraction of what a heavy, low-resolution box TV cost in the 1990s.
Everyone has a screen.
Right. Every single one of us carries a literal supercomputer in our pocket that connects us to the entirety of human knowledge instantly. We have near infinite, virtually free entertainment streaming into our homes 24 hours a day.
Global food supply chains.
Exactly. Unprecedented diversity and global access.
Yeah.
By almost any historical metric of luxury, convenience, and technological leverage, we're living like absolute monarchs compared to our own ancestors.
The baseline of luxury is undeniably higher.
So the critics ask, shouldn't we feel happier and more secure than any generation in human history? Why is financial anxiety so pervasive if our objective quality of life is so technologically advanced?
It is a vital observation, and the researchers in the Smart Money USA documentary categorize this exact tension as the middle-class paradox.
The middle-class paradox.
The core of the counter-argument is factually correct. Globalized supply chains and rapid technological innovation have driven the cost of many manufactured consumer goods down to historic lows.
TVs are cheap.
TVs are incredibly cheap. However, the paradox emerges because cheap discretionary goods cannot mathematically offset the exorbitant inflation of structural necessities.
So having access to a $300 65-inch television doesn't actually matter if you cannot secure the mortgage for the living room required to put it in.
Precisely. Possessing a miraculous supercomputer in your pocket is a massive technological leap, but it does absolutely nothing to alleviate the burden of your inflated property taxes.
Or your auto insurance.
It does not reduce the compounding premium on your family's health insurance policy. The paradox exists because modern society has conflated the hyperconsumption of cheap, highly visible technological goods with actual resilient wealth.
We confuse stuff with security.
True wealth and genuine economic security is not measured by the volume of goods you consume. It is exclusively measured by the capital and flexibility you retain after securing your basic existence.
This brings us right back to the divergence between gross income and actual liquidity that we discussed earlier.
It is the ultimate differentiator. Consider two hypothetical households navigating this economy.
Okay, laid out.
Household A earns a gross income of $120,000 a year. They aggressively utilize credit to maximize their lifestyle footprint.
They want to look the part.
They lease premium vehicles, they maximize their mortgage qualification for a large home, they possess the latest technology, but behind the scenes, they only hold $5,000 in liquid emergency savings, alongside $80,000 in compounding consumer and student debt.
Okay, so they look rich, but they are incredibly fragile.
Exactly. Household B, conversely, earns only $80,000 a year. However, they intentionally reject the relative consumption trap.
They don't play the game.
They drive 10-year-old, fully depreciated vehicles that they own outright. They carry zero consumer debt. They opted for an affordable rental or a highly conservative mortgage.
What's the balance sheet look like?
As a result of those choices, they have managed to accumulate $100,000 in liquid investments in diversified index funds.
Wow. If you line them up next to each other in a parking lot, household A undeniably projects a much higher social status. They look richer. But household B is the one that is actually bulletproof.
Household B possesses vastly superior systemic resilience. If an economic recession triggers widespread layoffs or a localized inflation shock occurs, Household A faces immediate catastrophic collapse because they have zero margin for error in their cash flow.
The treadmill stops and they fly off.
Household B can comfortably weather a prolonged storm without altering their standard of living. This stark behavioral distinction between high consumption, debt leveraged living and high resilience, liquidity focused living is rapidly becoming the primary dividing line within the middle class itself.
Which perfectly contextualizes the final set of Pew Research data presented in the documentary regarding how the middle class is structurally shifting.
The demographic shift.
We constantly see these alarmist headlines claiming the middle class is vanishing entirely. But the actual demographic data paints a much more nuanced and perhaps more complicated picture, doesn't it?
It does. The narrative of a complete evaporation is inaccurate. Pew's longitudinal research indicates that the share of American adults living in middle-income households did fall, dropping from approximately 61% in 1971 down to 51% in 2023.
So mathematically, the sheer size of the cohort did contract by 10 percentage points.
A 10% drop over 5 decades, yes.
Where did those millions of households actually go?
That is the crucial analytical question. The cohort did not universally collapse into poverty. While a portion of the demographics certainly experienced downward mobility into lower income tiers, a highly significant percentage actually moved upward into upper income tiers.
So it's spreading out.
The overarching economic distribution of the United States polarized. The middle didn't simply vanish into an economic black hole. The extremes on both ends of the spectrum expanded at the expense of the center.
So despite the squeeze, the American middle class does still exist as a mathematical reality. Over half the country remains situated in that middle tier.
The demographic tier exists, but the financial requirements to maintain the traditional package of a middle-class life have changed.
The secure housing, the reliable transportation, the comprehensive health care, the ability to fund a retirement without relying solely on social safety nets.
All of that has become astronomically more expensive. It demands a vastly more robust, highly disciplined financial foundation than it did a generation ago. And, as the documentary repeatedly emphasizes in its conclusion, geography is increasingly dictating outcomes.
Because the concept of what constitutes enough capital to secure that package is now entirely dictated by your zip code.
The standardization of the American economy has fractured. An annual household income of $90,000 might provide deep generational financial security, the ability to purchase a home outright over time, and a highly comfortable life in certain regions of the Midwest or the South.
Right, but if you take that same 90 grand to the coast,
That exact same income profile might necessitate living paycheck to paycheck, indefinitely renting with roommates, and utilizing public transit just to survive in Tier 1 coastal cities like Seattle, Boston, or New York.
we have unpacked an immense amount of macroeconomic data today. We've gone through the shifting income brackets, the hyper-financialization of the housing market, the structural traps of auto-dependency, the insidious math of baseline inflation, the consumer debt time machine, and the psychological warfare of social media consumption.
It's a lot to process.
As we synthesize all of this for you listening at home, what is the core takeaway? If the true cost of participating in the middle class isn't just about hitting a magic salary number, what is the actual currency we are trading in?
The central thesis of the documentary and the reality of the data suggests that the true cost of being middle class today is the escalating price of maintaining security.
Scary.
It is the raw cost of buying peace of mind in a highly volatile system. It is the ability to secure housing without it consuming half of your waking labor. It is the capacity to maintain reliable transportation so you can access the labor market.
It is the power to access healthcare without risking personal bankruptcy.
It is, ultimately, the ability to absorb a $400 disruption to your life without being forced to swipe a credit card that charges 24% interest.
It is the realization that true wealth in the modern economy isn't about luxury or visible consumption. True wealth is freedom. It is acquiring the most powerful, liberating word in the English language, The ability to say no.
In a hyper-financialized economy, the capacity to say no without facing existential ruin is the ultimate metric of personal security.
It's having the sheer financial resilience to say no to a toxic boss or a deteriorating work environment because you aren't terrified of missing a single biweekly payroll deposit.
Exactly.
And it's having the capital to say no to high-interest debt because you deliberately built a cash buffer between yourself and the world. It's saying no to the ambient, low-grade panic that keeps so many people awake at night.
And this framework explains why simply asking whether Americans earn more absolute dollars today than they did 50 years ago is the wrong analytical question.
It misses the point entirely.
The data clearly shows that they do earn more. But the only equation that practically matters to human well-being is this: how much of your capital remains under your control after you purchase the baseline infrastructure that modern society requires you to have?
Looks left over.
If your entire gross paycheck is immediately spoken for by mandatory, unyielding structural expenses on the first of the month, you may possess the required income bracket, you may lease the appropriate lifestyle, and you may look incredibly successful in a photograph.
But functionally,
Financially, structurally, you have absolutely no oxygen in the room.
you have no room to breathe, no margin for error, and no agency. And that loss of agency is the real hidden cost of the modern middle class. Which leaves me with one final provocative thought that really builds on everything we've unpacked from the Smart Money USA documentary today.
Let's hear it.
If the definition of enough has become entirely hyper-localized, and if the financial barrier to entry in these major prestige coastal cities is now mathematically insurmountable for the average earner no matter how hard they work, are we on the precipice of a massive, unprecedented geographic reshuffling in this country?
It's entirely possible.
Will the new, redefined American dream simply stop being about fighting a losing battle for a tiny, overpriced apartment in a Tier 1 city? Will the ultimate middle-class status symbol become the act of packing up, abandoning those prestige cities entirely, and strategically relocating to regions where your hard-earned money actually buys back the freedom to finally say no?